In July 2024, UK inflation surged to 3.8%, marking the highest rate in 18 months, a clear indication of ongoing economic challenges. Official statistics released on Wednesday reflect that consumer price inflation in the UK increased from 3.6% to 3.8% over the past year. This surge not only cements the UK's standing as having the highest inflation rate among G7 nations, but it also highlights the pressures that consumers and policymakers alike are facing. The inflation affecting the service sector, a crucial focus for the Bank of England, BOE, saw a notable acceleration, jumping to 5.0% from the previous month's 4.7%. Interestingly, while the BOE had anticipated a rise to 3.8% overall, they were surprised to find that service price inflation exceeded their forecast of 4.9%. Economists surveyed by Reuters had generally predicted lower figures, with expected increases of 3.7% and 4.8% respectively. In a recent decision, the BOE did cut interest rates, but this was achieved through a narrow 5-4 voting outcome among its members. They hinted at a more cautious approach moving forward regarding rate cuts, now that inflation remains stubbornly elevated. Interestingly, the value of the British pound saw a minor uptick following the inflation announcement, as market participants began to anticipate a longer wait before the next interest rate reduction by the BOE. In fact, a gradual quarter-point cut is not fully anticipated until March 2026, even though earlier forecasts suggested that the next cut might happen by the end of 2025. Deloitte's chief economist, Ian Stewart, commented on the current economic environment, stating, "The economy is encountering a phase of high inflation alongside sluggish growth, a trend that is expected to persist until spring. The future of the BOE's rate cuts remains uncertain." Furthermore, the BOE projects that British inflation could reach 4% by September, which is double their target, and remain above 2% until at least mid-2027. This contrasts sharply with inflation figures in the United States, which hovered at 2.7% in July, and the Eurozone, where inflation is expected to stay around the European Central Bank's target of 2% for the foreseeable future. This stark difference in inflation rates can be attributed to how energy and utilities are priced in the UK. Significant hikes in utility costs back in April have drastically affected year-on-year inflation comparisons. Furthermore, the labor market in the UK is relatively tight, a situation that has been further complicated by the lingering impacts of Brexit and is contributing to upward pressure on wages and prices. Even though wage growth has decreased to about 5%, this rate remains too high for the BOE to feel at ease regarding inflation's timely return to the target of 2%. Additionally, employers are facing increased costs due to a tax hike implemented by Finance Minister Rachel Reeves in April, alongside a substantial rise in the minimum wage, which inevitably leads them to pass on costs to consumers. The data released indicated that a major driver behind July's inflation increase was transportation expenses, notably airfare costs. It's worth mentioning that BOE policymakers often take airfares into account selectively because of their inherent volatility. Increases in electricity, gasoline, soft drink prices, and hotel accommodations also played a significant role in pushing the annual inflation rate higher between June and July. Interestingly, the Office for National Statistics, ONS, clarified that the recent tour by the British rock band Oasis did not inflate hotel prices, despite past instances where similar events increased costs, as seen with artists like Taylor Swift. Food and non-alcoholic beverage prices, a key factor impacting public perception of inflation, saw a 4.9% increase year-on-year, the largest since February 2024. The BOE projects that food inflation will peak at 5.5% by the close of the year. The ONS had also recently provided data indicating that the economy has enough momentum to sustain high inflation rates. Economic output in the second quarter exceeded expectations. And although the labor market has seen job losses, it is showing signs of stabilization. On Wednesday, the ONS also revealed that basic pay settlements in the private sector have remained steady at around 3% for 8 consecutive months, according to the data firm Brightmine. Despite some criticisms towards the ONS regarding data accuracy, they reported identifying a minor error in handling seasonal data, which does not affect the headline Consumer Price Index, CPI. As we navigate these turbulent economic waters, the ongoing inflation and mixed signals about growth raise essential questions. How will consumers adapt to these price hikes? And what measures can be taken to counteract the inflation trend? Share your thoughts below.